Mr. Hardin, you are basically a family farm in Avon, which is in Indiana. You raise about 12,000 market hogs per year, and you cultivate 2,300 acres of corn and soybeans. How does this tariff increase affect your business?
I can say that so far it's been very negative overall. As Sterling indicated, obviously there's a lot of dynamics in play. The soybeans that we produce are also used as feed for our animals. So while we've seen some improvement to our cash flow position by the fact that soybean prices have dropped quite significantly here just since Memorial Day, it still is kind of a bleak outlook for us going forward with depressed futures prices going forward for the rest of the year.
And so, Mr. Hardin, what do you do about that? What do you do sort of day to day to make sure that you're doing the right thing economically for your farm and for your customers, for that matter?
Obviously, it's as a farmer and a producer of commodities. We're in a purely competitive, strict market, so it's kind of hard for us to do risk protection. Normally, we would use the futures markets, but obviously, with the amount of uncertainty that we're looking at going forward with trade, we're seeing depressed futures prices all the way out into 2019. So it makes it hard for a producer to hedge and lock in any kind of advantage in the market right now. So basically, we're in a mode where we're trying to strictly control costs. Obviously, in a lot of our costs are things that we can't control, like energy. But we're trying to hold the line on things like repairs. Unfortunately, one of the things that people don't think about, agriculture is very reliant on steel for a lot of things, like grain bins and replacement flooring in our hog facilities. And we've, with the tariffs, we've seen the price of those inputs go up. So
right.
We've shelved some planned modifications and remodeling that we had slated for our facilities.
Now, Sterling, the conversation, of course, and what prices are showing is that China will just buy less soybeans, for example. But if you come inside the Bloomberg, this is really going to decipher the two. China buys the most soybeans from the U.S. as well as Brazil. The white bars are its imports from the U.S., and the blue bars are that from Brazil. Will China be able to make up what it needs from Brazil at the end of the day?
Over time, this will be a process as we see more production coming out of Brazil. Near term, they won't be, and that demand won't necessarily go away. Once you have these animals, you tend to feed them, and that demand is not something that can fluctuate that quickly. But the big fear that I have here for U.S. agriculture is China invests in infrastructure elsewhere, and all of a sudden we have lost this customer permanently because we have to expect China to protect their food security. They will do that.
And so what we heard from Mr. Hardin, the farmer, our hog man, as you said, I mean, those are real business decisions he's having to make. I would imagine he's not alone in that regard. So play that out. If he's not able to take advantage of the futures market, if he's making CapEx decisions, what does that look like?
Well, what it causes depression, and what will end up in the farm economy, you'll see it break down. You'll also see herd liquidations. If you can't get the right prices for your hogs or your cattle, you're going to have to move this into the market, and we'll see retail prices drop, and then we'll end up with prices escalating back, but then there'll be lower demand for corn and soybeans, and you get trapped in this spiral. And most farmers hedge a little bit, but unless you really got your things on exactly at the right prices this year, prices were never that good, and farm margins were not very good either. So there wasn't a lot of incentive to do much hedging right here.
So, and Dave, Sterling really outlined sort of the broader issue for you going forward. If you were selling your product to China, are you looking for a new market for that product now, and where is it going to be?
the U.S. pork industry is the low-cost producer of pork around the world, and we also like to see ourselves as the best product. So we had been, as an industry, kind of going through an expansion mode and gearing up because a couple of years ago we saw, new markets coming online potentially with the Trans-Pacific Partnership. The Asia Rim. A lot of countries there where incomes are rising. People are looking to consume more protein. Well, obviously, the second day in office, the president took that off the table. So trade in general is a bit of a tough spot right now. Canada and Mexico are two of our biggest export markets, and our trade relations with those two countries are not the greatest right now. So there's a lot of trepidation, I think, out there in farm country right now about what the future holds.